It started off a good day, and then literally out of nowhere, we got rugged. That's right, the Fed has rugged us once again, and it's a pretty disgusting sign of the times that effectively the Federal Reserve is looking to deflate this wild overheated economy that we are currently participating in. So we're gonna bring you through exactly everything that happened, and then I'm gonna give you my breakdown as to what I'm doing to prepare for this at the end of the episode. If you're investing in any markets right now, crypto, stock market, pretty much anything that trades against USD, maybe not things that trade against ETH, but we'll talk about that at the end. This is a video you have to watch. Let's figure out what happened. All right, so everybody knew that today Jerome Powell and the Fed were going to have another meeting and give an updated view on what they were going to do to address inflation, what they were going to do with interest rates. All of these things change very often because since the last time we heard from them, a lot has gone down. The market has tumbled. We're all very, very poor. So we need to understand, was this enough? Did Jerome Powell achieve his goal? And now he's going to be looking to kind of keep things stable. Are we underheated enough to resume business as normal? And we got that answer today, but it was a little confusing because the minutes came out first. What we're looking at here is the actual YouTube video of this live conference. Now, while we were waiting for this to happen, they released a prepared statement that went over their views, which essentially was business as usual, nothing has changed. But then we got into this press conference here, and as I will show you throughout this press conference with Jerome Powell, every response to every question got increasingly more and more what we call hawkish. Now, hawkish means that they're being very aggressive, and aggressive is not what we want right now. The alternative would be dovish. Dovish would mean kumbaya, keep pumping the markets, everything is good. But what we got was actually a hawkish Jerome Powell, and I'll bring you through a couple of the statements that were most important throughout this particular press conference so you can hear it directly what Jerome Powell said that effectively created this pump and dump on the charts. So this is Bitcoin, and right after the minutes came out, we got this massive pump. In fact, most people looked at the minutes as pretty bullish, myself included, because I tweeted pamp it. This was right as the minutes were released, and we could assume, okay, J Powell is going to come out with some very nice, even-handed type of delivery that's going to let us keep growing as a market. There's not going to be any bearish curveballs here. But then he came out and started talking on the press conference, and we got this absolute destruction to the point where we're actually down from the day instead of actually pretty massively up. Starting the day here at 36,000 or so and ending it over 40 would have been a major, major W. But instead, we got this massive decline. So what caused this and what does it mean for the future? Let's hear it straight from Jerome Powell, and we'll talk about my strategy positioning around this now that we're seeing how these market dumps are affecting his policy changes or not affecting them.
And I also wonder if you could talk a little bit about the pathway to getting to that deceleration. Like how do we get from here, 7% CPI, to where you expect to be at the end of the year?
So this question is the one where Jerome starts to bring out the fangs here. He's kind of been, going back and forth politically saying, hey, look, we want to reduce prices. We want to reduce prices. We're going to use, lots of political double speak, lots of big words. This is where he starts to get a little real here. And this is exactly where the market totally took a turn.
So I'd say, since the December meeting, I would say that the inflation situation is about the same, but probably slightly worse. I'd be inclined to raise my own estimate of 2022 core PCE inflation. Let's just go with that by a few tenths today, but we're not.
Okay. So listen. Before, we were thinking after this collapse, after the market has come down so significantly, Apple's, Netflix stock plummeting, Peloton plummeting, crypto plummeting, we're thinking, all right, well, we've probably taken some significant heat out of the economy, and maybe we're going to be looking to control prices with these predictable Fed interest rate hikes. But now he's saying that even since December, he thinks the situation's gotten worse, not better. So since December, when we've all been made intergalactically poor, here, Jerome Powell thinks the job isn't done. So this is what really sent the market into a frenzy today. And so let's listen to how he finishes this, and then we'll wrap this up.
Writing down an SEP at this meeting, but I think it hasn't gotten better. It's probably gotten just a bit worse, and that's been the pattern. So I think if you look at the FOMC participants, there's a range there. And that range has been moving to the right for a year now. And by the way, if you look at other forecasters, essentially all other macro forecasters who do this for a living, you've seen the same pattern. So what do we think about that? Well, I think we wrote down rate increases in the December meetings, each of us individually. And I think to the extent the situation deteriorates further, our policy will have to address that. If it deteriorates meaningfully further, either in the time dimension or in the size of the inflation dimension.
So as you can see, there's absolutely no desire based on the current market slide to adjust policy or that it's going to have any impact, which effectively is a signal right now to the bears. And we could go on and on here. The fact is that it's not going to change the reality that what Jerome Powell did over the course of this press junket here was he effectively got more and more hawkish, meaning more and more intense and severe sounding on the policy that he was going to enforce. So what does this really mean? Well, it means that no time soon are we going to get any alleviation from this Fed FUD, and that things like Bitcoin, which thrive on inflation as a narrative, are going to get, essentially cut down at the knees because the inflation narrative is being cut down at the knees. Now, of course, does this mean that inflation will be ultimately controlled? No. And that's why we've pointed to a theory that was surfaced by Cathie Wood, and we've discussed this several times, which is that if this gets really bad and that these policies start really affecting not only the stock market, but the actual labor markets, then we will see the flip-flop between right now, inflation is the big bad guy, inflation is the enemy we're fighting, that is the monster, the boogeyman under the bed right now. But as inflation starts to drip away and we start getting threatened with fears potentially of recession, which is the extreme of this, which if these policies hurt the economy too badly, a fear of recession would start to come into play. And that's where we'd start to be looking to the Fed to stimulate the economy again. So it would be a flip-flop. Now, what it does feel is that that is the most likely outcome. Everyone I've talked to seems to believe that a flip-flop out of the Fed is something that is more than likely. So the question is when? When will the Fed flip to be less hawkish and more dovish, more supportive of risk assets in the economy as opposed to essentially making life a little harder on them? Now, I want to point out a few things as well. Interest rate hikes alone are not a death knell for the markets. What's crazy is the stock market actually averages higher percent returns during periods where interest rates are being hiked. So there's absolutely no reason why you cannot make gains in risk markets during a period where interest rates are being hiked. What's important to realize is that big changes will cause shocks to the system. And the way that this is going, it certainly feels as though some more shocks to the downside are possible. So what's to be done here? Well, if you have any money on the sidelines, I think that's a good place for your money to be right now. There's no urge. There's no direction to the market. There's no motion to the ocean. There is a clear divide. If the Fed continues to loosen rates, we'll go on another massive bull cycle. If the Fed continues to tighten, it seems like Orange Coin is going to have a bad time. If the Fed just keeps things the way they are, it seems like Orange Coin and the whole crypto markets should be due for another wave of macro bullishness. Regardless, what we've seen is that the best hedge so far against this entire market, ironically, in the weirdest twist of fate, has been NFTs. Now, I want to reiterate, NFTs are not safe. There's nothing safe about them. They're extremely, extremely risky. However, they have held up extremely well against the market, and my theory about NFTs performing against the market during the winter for crypto seems to be playing out. So, of course, I'll be doubling down and going headfirst into the NFT sector, as it seems to be the only game in town, if not for dramatically growing wealth, for at least protecting it. So I'll be looking at NFTs, and especially as they overlap into gaming and gamified ecosystems. For a little extra data on top, gaming and video games are considered pretty recession proof because, like gambling, like makeup, these are things that people will do even when they're down and out to get entertainment, to feel a rush, to feel better, and to actually have their days improved. These are these kinds of activities that even thrive during recessions. So gaming is one of those things that, regardless of whether the economy is doing well or not, is most likely to perform. And especially looking at crypto, I don't believe there's another product category that can actually hold users during a bear market. It's why I started looking at gaming back in 2018. And if we're in 2018 all over again, ironically, the year after the halving, 2 years after the halving, it's been really bearish the last few cycles. And it's looking like, not due to crypto this time, but due to the Fed, it's going to be a fairly bearish year as well. The reality is this could change in a split second with a new update from Jerome Powell or a flip-flop of sorts. So we need to be just hanging on, watching watching the Fed, understanding their motions, and understanding what demon they're trying to slay right now. And right now it's inflation. Until they move away from trying to fight inflation, it's going to be really hard for this free, easy policy. Now, that does not mean that there's not gains to be had. It just means that the overall market might stall out for a little bit. In this time, I'm going to be looking for the product categories and the projects that are probably trading at major discounts, and I'm going to be looking to accumulate, not for any kind of extreme short-term gains, but for long-term exposure to the gaming space. Pretty much, I'm going to be focusing on NFTs and gaming as always, but even more so because the rest of crypto has just gotten extremely boring, and the likelihood of pumpage coming out of just the generic altcoins or Bitcoin itself has gone down the toilet with this Jerome Powell press conference. Now, you see how quickly things change. No, they can change to the upside just as fast. So the biggest thing that you need to be doing right now is staying in crypto, paying attention, and waiting for the market to reset, find a bottom, and build strength. But for now, it does feel as though the NFT world is still very hot, and I believe that there is a lot of gains to be had, especially as NFTs start to be seen as fairly immune to these market turndowns. It could get to a mania phase in the not too distant future, and of course, that's when you want to be selling. Anyways, this is how the Fed rugged us. This is my strategy. If you guys like this video, smash that like button and like the video. As always, I'm EllioTrades. You can find me on Twitter at EllioTrades, and I'll see you very soon on the next episode.